All right. Well, good evening, everyone. Welcome to our Oklahoma State Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Appreciate you attending our very first Oklahoma State Alumni Workshop. This is a class that we're going to present every quarter to you. So really excited to be able to bring this content to you on a quarterly basis. We're going to have this be a very interactive session this evening. So really encourage you to ask questions as we roll through tonight's content. We've got a lot of great participation for our first class. So we'll allow all of our folks that signed up for tonight's class to be able to get into the Zoom session. We're just about a minute or two past the hour. While we're waiting for everybody to get settled in for tonight's class, just want to kind of share with you a little bit about me and our organization. So I work with a company called American Pacific Mortgage, and we partner with university alumni associations all across the country to bring homebuyer education to those communities. And I have the pleasure of presenting this material all across the country. Like I said, this is our first workshop with Oklahoma State, but really grateful for the opportunity to be able to partner with the association and bring this information to you. American Pacific Mortgage is a leading lender across the country. In fact, we're a top 10 direct lender across the country. And so our team in particular sponsors classes like this to help guide you on the path towards homeownership and ultimately kind of just provide tools and resources. So when you do decide to make that decision of home buying, you have a resource for you to help you on that journey. Well, tonight's class is very interactive. I encourage questions as we go through tonight's content. So we'll kind of weave in those questions as we go. My colleague and I will be kind of answer those questions. You can put those questions in the chat function in Zoom, or you can use the Q&A function and we'll make sure we get those questions answered. I want to take a quick poll from the audience as we get going, because since this is our first class for Oklahoma State, love to get a sense of where everybody's at. My initial reaction is most of us are probably in the Oklahoma or Texas markets, but if you can, just put in the chat kind of where you're joining us from. That's helpful for me as your presenter this evening, because then when we talk a little bit about market data, we can kind of zone in to maybe a few of those areas that are in the respective markets that you're living in or maybe considering purchasing in. Okay, so drop that in the chat if you get a second. That's always fun for me to kind of see where everybody's at. And so I was wrong just at the initial reaction. So we got some folks in Massachusetts, we got Tennessee representing, Texas, Oklahoma. Very cool. Okay, I appreciate you guys kind of checking in with me on that, kind of a quick poll of where we're at. Let's go over our talking points for this evening. So we're going to talk a little bit about the housing market. We're going to kind of specifically look at the Oklahoma market right now in just a bit. We're going to talk a little bit about the housing market. What does it look like today? What's some of our early projections for 2025? We'll also spend some time looking at interest rates. From there, we want to talk a little bit about, does buying make sense for us? So we're going to walk you through a rent versus buying calculator to think a little bit more about, what if I continue to rent for X amount of years? How does that compare versus me owning a home over the next few years? I also want to share with you a little bit around credit, how to understand your credit a little bit, also know what tips and resources are available to you in the space of credit. We then will transition into various loan programs that are available to you as first-time buyers. And then I want to talk a little bit about, how do we save for home ownership? So as I'm thinking about putting home ownership as a near-term goal for myself, what does my savings need to look like as I anticipate for expenses like down payment, as well as closing costs to buy my home? We'll also talk a little bit about first-time homebuyer programs that can be a resource to help you reach home ownership that much sooner. And then I want to share with you a little bit about the buying process. So after tonight's class, you may say, hey, Jason, I would love to connect with you to learn a little bit more about how I can set my own goals and objectives for home ownership. So we're going to show you how to get on that path towards home ownership. And as I leave today's class, what are some of the milestones that I'll experience as a future buyer? Finally, we'll also talk a little bit about consultations and what that means in designing home buying plans for you as a prospective buyer. All right, so we will dive into that stuff again. feel free to put your questions in either the chat function of Zoom or the Q&A. I have both windows open, so we'll make sure we get any questions answered for you. We did have a question already in the chat, which is on physicians loans. We'll talk more about specific loan products about third of the way through tonight's class, but there are physician loans products. I think I'll probably just table that for a little bit later in the class, and I'll kind of give you a little bit of a comparison on how physician loans stack up versus more traditional products. Okay. All right, well, let's go ahead and think more about like, what does buying look like for me, right? Does buying even make sense for me as a prospective home buyer? Because this is going to be a big decision for us financially, right? Probably going to be one of the biggest financial decisions we decide to make. So the fact that you guys are taking time out of your busy schedules on a Wednesday night to join this class obviously shows and signals the importance of making a really smart decision for home buying. And as we're considering home ownership, I think there's other things to consider versus just looking at, what am I paying in rent versus what's going to look like as a prospective homeowner budget. And things like controlling affordability is really important for us. So we can create stability in a housing budget for us versus waiting for our rent to increase with maybe the renewal of a lease, for example. Even though we're at more elevated interest rate levels in today's market, there still will be hopefully an opportunity for us to refinance in the future, which essentially is when I take where my market value is in my home and what I purchased my home for, and at a later date, look to maybe kind of change the terms of my loan by basically reducing my existing rate down to whatever the market rate is. So some of my clients that are buying today in this higher level of interest rate environment, in a couple of years, they'll be able to improve their affordability by taking advantage of lower interest rates. And this is an asset that should grow over time, right? So as my home goes up in value, the difference between what my home value is versus what I owe on my mortgage is called home equity. For most of us across the country, that's the number one asset that we have in our portfolio. And so being a homeowner creates that opportunity for my value or my wealth to grow over time and potentially to be able to pass that wealth or assets along to heirs of my estate. Believe it or not, there's also some really great tax benefits that come along with owning a home as well, too. Potential tax deductibility of interest of the mortgage that you have on your home. There can also be other tax benefits as it relates to energy efficient upgrades that we have in our home. So when we think more about home ownership, I would encourage our class, we want to think through all of the other benefits that come along with owning a home, because from my perspective, it's not necessarily an apples to apples comparison when I'm considering my existing rental situation versus owning a home. And to kind of help like illustrate that point, I like to take you guys into a quick calculation. We call it our rent versus buying calculator. I'm going to switch up screens here so we can walk you through this. And this ultimately kind of for us shares with us, like, what's it going to look if I decide to purchase a home versus continuing on my path of renting. Now, by the way, as a quick side note, all of our material from tonight's class, we're going to send back out to you tomorrow morning. Since you've registered for tonight's class, we'll send you all the registration material. We're also recording tonight's class. We'll have that up on our YouTube channel. We'll share that link back out with you as well, too. Those presentation materials will also include this link that I'm going to walk you through right now. And again, this is called our rent versus buying calculator. And this is a great tool to kind of start that path towards home ownership. And let's kind of walk through a realistic example in tonight's class. And so let's start with the rental side of this calculator. And that starts with, what am I paying in rent, right? So in this scenario, I'm paying $1,500 in rent. We have a buyer that has renter's insurance at $15 a month in rent. And then I'm going to make the assumption that my rent's going to go up about 3% on an annualized basis. Okay. So that would be where I'm currently standing from a rental perspective. And then if I'm considering home ownership, we have for this exercise a $250,000 purchase price. We have an estimated down payment of 3% of my purchase price. Now, we're going to learn more about down payment options in our programs segment, where we talk a little more specifically about loan options. But ultimately, on a conventional home loan, the minimum down payment is 3%. We have estimated property taxes at $3,125. Those property taxes will vary based upon where I'm at in different parts of the country. We have homeowners insurance. We also want to factor in the maintenance costs of my home. So that's all kind of factored into the loan calculation. And then from a loan information perspective, we're going to have a 30-year fixed mortgage as our mortgage product. That's most typical for most of our first-time buyers is a 30-year fixed option. There are various terms that you can select as a buyer, but most common is a 30-year loan. We have average interest rate right now at 6.8%. We're going to talk through that a little bit more in tonight's class on the interest rate environment. We have discount points. Discount points are essentially where you as a buyer can pay additional funds out of pocket in order to bring down that interest rate. Now, discount points usually equate to 1% of my loan amount. So let's say I'm going to borrow $200,000 and I pay one discount point. Well, generally that'll equate to about $2,000 in additional cost for me as a buyer. Now, that will translate to about a 0.25% reduction in interest rate. Now, in today's market, while we're at still elevated levels, I don't necessarily recommend buyers to pay those discount points because the return on investment for discount points is usually about 3 to 4 years. And I kind of talked really quickly about, our scenario with clients in terms of refinancing down the road. Most of our clients are probably going to consider refinancing a couple years. So investments like discount points honestly don't make a lot of sense. Now, I kind of just skipped over one of the sections, which is origination charges, but I want to get back to that. Those are the costs that a lender is going to charge you for their financing options. Now, one of our discount benefits that we have in our Oklahoma State partnership with the alumni is we actually discount our services by $750. So since you're part of the Alumni Association, we basically reduce our cost of our financing options for you. So another cool benefit that you have available to you. Also, we have other settlement services as part of a home purchase. Those are all about closing costs. So when we think about saving for homeownership, we have down payment, but we also have closing costs. Other settlement services are going to be things like attorney fees, maybe title and escrow fees, depending on what state we want to purchase in. Could be government charges like county transfer taxes, things of that nature. I would encourage clients when they think about budgeting for closing costs to factor about 2 to 3% of their purchase price for those estimated closing costs. And then under other assumptions here, which is our last section of this calculator, we have appreciation rate. We put in 4%. We can adjust that depending on where we're at in the country and where we're buying. Obviously, appreciation rates change by community. We have expected years in the home at 7 years, the cost of selling my home at 10% of the sales price, state and federal tax rates, and then finally we have savings rates at 1%. Now we could argue probably that savings rate could be a little bit higher, but we put 1% for our calculation here. So here's what we need to look at then as we consider home ownership. So from a payment perspective, if we look at this kind of section here, we know we're paying in rent $1,500 a month. If we decide to transition to home ownership, we're jumping up to about $2,200 a month. So that's about a $700 increase. But what I would encourage our class to think about tonight is what does my opportunity look like over time? So if I was to side by side compare 7 years of ownership versus 7 years of renting, I have about a $49,000 upside of owning versus renting. Now, I know that could look a little bit different for each of us in each of our markets because, especially depending on what we're paying at rent, how that translates to homeownership, that could look a little bit different. But ultimately, for this scenario, for a client looking to purchase for $250 and renting today at $1,500 a month, about a $49,000 opportunity. Okay, I saw some in the chat, the audio went out, but somebody else is saying audio is good. So maybe it might be on the other side, but yeah, I appreciate that. Thanks for commenting there. All right. Good deal. We don't want technology issues. Not helpful. All right. Well, I appreciate you guys walking through that calculator. Let me just transition us back into our slideshow. And now let's talk a little bit about the housing market. And I think let me just kind of get us enlarge this a little bit for us here. We can get it in full screen mode. Okay. All right, cool. So we should be good there. So let's talk a little bit about the housing market. And, we're kind of in this seasonality of the markets right now because obviously we're in the winter months right now. It's cold in most parts of the country, so not a lot of activity, you would think. But this market seems to be a little bit different right now. Seems to be a lot more buyer activity out there. And so as we're kind of looking at the housing market right now, generally you would see less buyers active right now. But that has changed as we've started 2025. Now, I'm giving you a snapshot of the Oklahoma housing market over the last 3 years. I know some of us are in different parts of the country, but ultimately, this is a decent snapshot in terms of trends. Prices obviously look a lot different. So if I'm in, Nashville today and I'm looking to purchase versus buying in Stillwater, that's probably going to have a little bit of a price variance, right? But overall, the seasonality in the markets trends look very similar. Of course, some markets are going to appreciate at higher rates than others. But to go back to my point around the seasonality, traditionally in this time of the year, we don't see a lot of buyer activity because, it's cold. People don't want to necessarily hop in their car and look at a place. But as we move into April, May, June, July, August, we start to see buyer activity pick up. Warmer weather, maybe families are deciding what schools they want to put their kids in. So maybe they want to be in a certain community. So generally we see buyer activity pick up. This market in 2025 is a little bit different. I think there's a little bit of a pent-up demand out there because we have been at these elevated interest rate levels for the last year and a half, 2 years. And so I think right now we're seeing buyers kind of re-engage in the market, which is creating a lot of activity out there. Now, the challenges that we have in most parts of the country, there really isn't a lot of inventory on the market. There's not as much supply out there for buyers. Now, you can see in the Oklahoma market, homes are staying on the market about 58 days on average. So that's really kind of par for the course, so to speak, for most parts of the country. Even if I'm looking at some markets in California, that's a little bit, it's pretty close to that number, maybe even a little bit less. If I was go kind of push out into maybe some other markets like on the East Coast, that number looks very similar. I think the difference right now is really where the price point looks at. And so that kind of leads me to my next thought, which is as we kind of project into these markets for 2025, the question is really going to be how much inventory do we have to support the buyer activity levels? Because I do think the activity levels will remain pretty strong, even at higher interest rate levels. And the challenge we could have in the market is if interest rates slip a little bit, buyer activity is only going to pick up. And if we think about supply and demand, right, if we have limited supply, high demand, that could push prices up. Now, it's all relative to the market that I'm going to purchase in. Some markets will go higher than others. Some markets might already be at a certain tipping point, and we might see some pullback in the markets. But I think the takeaway from where the housing market's at right now is I think it still has some more runway in terms of what buyers can get into the market, even though we remain at these higher interest rate levels. Now, interest rate is obviously going to fuel buyer demand too. And so I think it's really important to kind of look and see what's going on with interest rates. Now, interest rates can change by the minute based upon the financial market activity. Today, we actually had a really good day in the interest rate markets. We're starting to see interest rates slip a little bit, which is good news. We have been at elevated interest rates for the last year and a half, 2 years. Today, we're at almost 4-month lows in interest rates, which may not mean a lot to most of us in today's class, but as close as we watch the markets, that's a big movement. Average interest rates probably now slipping closer to 6.75, whereas just around the corner we were closer to 7%. And visually for a consumer, that's a big deal, right? If we can get under 7%, not only does it improve affordability, but just the optics on a lower interest rate certainly help us as consumers. Well, let's take a look at what we've seen in interest rates over the last 12 months. You can see kind of this wild roller coaster ride that we're on right here. We're just below that 7% threshold. When we entered spring of 2024, interest rates hit one of their highest levels. We were kind of hovering around the 7.25 range. And why we're at these higher elevated levels is because the Federal Reserve is trying to combat inflation, and most of us are feeling it, right? The cost of everything is more right now. So I go to make a purchase at the grocery store, higher bill I'm going to walk away with. If I go to put fuel in my car, higher cost there as well too. So the Federal Reserve is trying to combat inflation by elevating the federal funds rate. Now, the Federal Reserve has a goal of 2% inflation and then a stable labor markets. We're getting closer and closer to that inflation goal. In fact, the reason why today's interest rates have slipped a little bit is because we've seen a little bit of a softening in inflation. So, it's showing stronger signs that the Federal Reserve will start to come off these federal elevated rates that we have right now. So The Federal Reserve will meet next month. We don't think they're going to cut rates next month, but we're anticipating a future rate cut. And as the federal funds rate comes down, we should see mortgage interest rates kind of have a ripple effect from that as well too. Last thing I want to kind of touch on with interest rates is kind of just getting a kind of realistic perspective, especially over the last 20 years. So, where we're at today is certainly not the highest we've ever seen interest rates. One of our highest in the last 20 years was just in October of 24. Interest rates hit almost 8%. Well, obviously we've come off those highs, but if it's interesting when you look back to 20 years from today, we're almost at the same levels of interest rate, right? Now we've gone through different cycles. We have the housing crisis that's represented here. Interest rates kind of dropped, not much, but certainly came down a little bit here. And then we have the pandemic that's represented in this line here. Obviously, interest rates hit all-time lows at 2.5%. I think the question I get from most clients is, when are we going to get 2.5% rates again? Well, probably not likely. And, if something like that did occur, that means something's really bad it's happening on in the world. And, unfortunately, bad news in economics markets or news in general will generally push down interest rates. But, I think where we're at today with interest rates at around that 6.75 rate, I think we're probably going to stay somewhere in that range as we go through 2025. We probably won't see really reduction in interest rates until we get into 2026 and then obviously into 2027. Normalized rates historically would be somewhere in that 5.25%, 5.5% range. So certainly the 2.5% days were not normalized by any stretch. Now, I think it's important to understand that there's several different characteristics that go into interest rates. So even though my colleague at work achieved this interest rate or my neighbor got this interest rate, doesn't necessarily mean that's going to be the same thing for me as a buyer. So credit score and eligibility factors into what my interest rate output looks like, the program that I'm going to select, how much my down payment is, how much I decide to finance. Am I going to pay points to bring down my interest rate? We talked a little bit earlier about that as well. And what type of term of my loan am I going to do, right? So usually the traditional loan is a 30-year term, but let's say I want to shrink that down to 20 years or maybe even 15 years. That could help potentially bring down the cost of my interest rate. Now, ultimately, during a consultation with our clients, we're going to figure out the right solution for you, right? We're going to design a home buying plan for you that includes what interest rates match up to the type of product that you're going to look at and figuring out the right solution that helps you achieve those goals ultimately of home ownership. All right. Okay. All right. Well, let's kind of transition over to credit. And I want to talk a little bit about credit because credit's probably one of the bigger drivers of kind of dictating programs for clients, interest rate offering. And so when I think about home ownership for clients, there is probably two challenges to home ownership. One could be savings for home ownership, which we're going to talk about a little bit later, or it could be around credit. So, I think it's important to really discover what credit looks like for each of us. Now, there's so many tools that are available to you to give you kind of a visual or a better understanding of where your credit score is at. But I think if we can go a little bit deeper, kind of explain to you a little bit more from the lending perspective, I think it'll certainly help you. And it's important to understand that every loan program has a minimum credit score to achieve that particular program. So we have some of them listed on screen here. So our government insured FHA product is 580. The conventional loan product is 620. For our veterans that have eligibility, it's a 620 score. And some of the first time buyer programs usually have like a 640 minimum credit score. Now, we're going to talk about what goes into credit score calculations in just a minute, but there are factors like major delinquency events that could impact my score more significantly than others, right? So like bankruptcy, short sales, foreclosures could have a bigger impact on my credit score. I'm going to spend some time educating you around credit utilization in a little bit. So what does that look like when I compare my credit card balances versus to what the credit limits are? Now, account closure is looking simply at my revolving activity, which essentially means if I close out in a revolving account, it could have a negative impact on my credit score. And then we're also going to talk a little bit about how we look at the credit scores or each agency's credit scores. Now, this is a matrix that's going to kind of show you how long negative items will stay with you on your credit report. Things like hard inquiries, that's where a lender or credit card issuer has access to your credit file. They'll stay with your credit file for 2 years. The impact to your credit score is really in the most recent 6 to 12 months. Now, if I had a late payment, let's say on a student loan, and let's say it was in October of 24, that's going to have a bigger impact on my credit score than, say, a late payment on that student loan back from October of 2022, right? So usually events happening in the most recent 12 to 24 months are going to be the biggest impact to my credit score. Now, we all know the three credit agencies that report. There's TransUnion, there's Experian, and then there's Equifax, right? Now, in lending, we look at all three scores, but we take the middle score of all three agency reports. So as a buyer, if my credit score is at 760, then my middle score is at 740, and let's say my lowest score is at 720. Well, from a qualifying perspective, I'm going to take the 740 score for my eligibility, right? But if I'm going to apply with my partner, but let's say my partner is at 720, 700, the middle score, and then 680 is my lowest score. Well, based upon the middle score being the lowest with my partner, we're going to use my partner's 700 score to determine eligibility. And that's important to understand because, that difference in score can affect my interest rate, could affect the cost of mortgage insurance. It can also affect the type of product that I'm going to select. All right. So we always look at the middle score in qualifying for financing. Now, there's three different models to credit scoring. There's a credit card model, there's an auto financing model, and then there's a mortgage financing model. Now, of course, if you're electing home financing, we're going to use the mortgage model for qualifying. And I thought I would share with you what the weighting looks like in the mortgage score calculation. So here's kind of what this looks like. You can see on screen, we have 15% is going to be the length of credit. So the longer my credit file is, the more mature it is, the higher my credit score could be. To my point earlier about closing out revolving accounts. So if I close out an account, what that does that can potentially negatively impact your scores, it basically strips away all the data and the history of that account to the credit agencies. So it's really important to be mindful of not closing out accounts that especially have longstanding history for you on your credit file. 20% is going to be how much new credit am I trying to get access to? Am I opening up new accounts? Am I doing inquiries on my credit to open new accounts? Those are called hard inquiries. Now, there's two types of inquiries, hard inquiries, and there's soft inquiries. In starting our process for home financing for you, we actually only start with a soft inquiry. And the reason we choose to do that with our team is because, especially for first-time buyers, you may not be purchasing a home until next year, but you really want to know your options, right? Or maybe you're not going to purchase until the end of this year. But the soft inquiry allows us to get visibility to your score without impacting the score. And I think that's a really important part of things. 10 or 30% down here is going to be how much do I owe on my credit card balances versus my credit card limits. That's called credit utilization. So really simple example, if I have $10,000 in limits and my balances are currently at $5,000, that means I'm at 50% utilization of credit. Ideally, if I'm trying to really get my optimal credit score, I would work hard to get that credit balances down to 10% utilization of credit. Now, let's say I just booked an awesome trip to Cabo and I have now $8,000 in credit card balances. By doing that additional charge to my cards, probably going to pull my credit score down, right? So what I would encourage my client to do is let's try to push that balance back below 50% utilization. That'll give me an improvement in my score. Once I have a little bit more savings, let's work towards getting to 10% utilization of credit. Last thing, which is kind of the simple one, which is payment history, right? How have I paid my bills? The more on-time payment history I have, better my credit score is going to be. If I have any late payments, those late payments are rated as 30-day lates, 60-day lates, and then also 90-plus day delinquencies. The more severe the delinquency, bigger impact I'm going to have on my credit score. All right. So that's a little bit about credit. Again, that's probably one of the two top things for home buyers to consider. It may not necessarily be because I have delinquent credit, just maybe because I'm overextended, or in some cases, we have clients that have other obligations like student loans. And so we're going to talk a little bit about student loans really quickly. And I just want to kind of give you some visibility, if you will, on how us as lenders consider student loans. Now, if you are carrying student loan debt that's federal student loan debt, most of those loans are in forbearance. And if they're in forbearance, that means you obviously have no active payments. If you're back in school, you might have a deferment of your student loan payments, and that's okay too. But from the lender's perspective, so us as APM, we do have to consider a minimum payment when it comes to qualifying with student loans. And so there's a couple of different ways we can look at it. If you're in forbearance right now and you don't have a payment arrangement, by default, we have to count 1% of the aggregate balances as your monthly payment to qualify for a mortgage. Now, if you're in an income-based repayment program, you're actively repaying, then let's say I have a situation where my income-based repayment is $250 a month. That's the monthly payment I can use to qualify for my mortgage. So that 1% rule basically comes in effect if I'm doing a conventional loan. If I'm doing an FHA loan, it's 0.5% of my total balances for the FHA considered payment. But as I mentioned earlier, with forbearance, that can, basically put us in a position where we're kind of in pause. From what I'm hearing is there won't be a ruling on the litigation that is pausing those student loans federally until probably September or October. So this is kind of an important part of qualifying on the student loan side of it for our clients. And so just want to kind of share with you how we kind of look at those things. But I guess the takeaway from this section would be is if you're in forbearance or deferment, and you're considering home ownership right now, let's talk through where those student loans set up with your financing options. All right, well, we're going to talk about loan programs, and the reason why student loans have guidelines set to them is based upon the factors that are considered in each one of these loan programs. And so we're going to talk about these 5 kind of core programs. I know I got a question earlier about physicians loans, which I'll kind of dive into in just a minute, but these are kind of 5 of the core programs that we have. There's a plethora of different programs available, but for us as first-time buyers, this is kind of where we would target. The first one is a conventional loan. That's a Fannie Mae or Freddie Mac loan. You might have heard of that in the past. Fannie Mae and Freddie Mac occupy about 60 to 70% of the origination space of all loans across the country. We underwrite and work directly with Fannie Mae and Freddie Mac as a direct lender. That product offering has a minimum down payment of 3%. Up to a loan amount of $806,500. We call that the conforming loan limit. That's all set across the country. Now, if you're joining us from a high cost of living area, and I didn't see any of the chats in there that would have someone that isn't a high cost of living area, but certain areas across the country, we can go up to as high as like 1.2 million for our amount financed. The conventional loan has a minimum credit score of 620. And that conforming loan limit that I just mentioned, it actually changes every year. So based upon cost of living numbers that come in, those conforming limits change generally about every October. The FHA loan product is a government insured loan. FHA stands for the Federal Housing Administration. So it is a government funded loan. Minimum down payment of 3.5%, minimum credit score of 580. The maximum loan amount with the FHA product will vary based upon where I'm going to purchase in different parts of the country. So each county has a set FHA maximum loan limit. In just a few minutes, we're going to do a comparison of mortgage insurance on a conventional loan versus an FHA loan because there's some pretty significant differences that I want to walk our class through. One of our things with FHA is it's not designed just for first-time buyers. It can be a second or third-time buyer. FHA not only has a little bit of a lower credit score threshold than the conventional product, but a lot more leniency from an underwriting perspective. So if I've had some past challenges, whether it's credit related, maybe I don't have the full savings, FHA can be a more flexible option, if you will, for some of our buyers. The jumbo loan product is for clients that need a little bit more funding beyond what maybe a Fannie Mae or Freddie Mac product can offer, but it does come with it higher down payment requirements. It also has higher credit score threshold. So usually once we get over that 806,500 threshold is where a jumbo loan comes into play. Now, since we're talking about jumbo loans, I think I also want to kind of talk a little bit about physicians loans. So a physician loan is a loan product that basically allows someone to purchase that's a practicing physician, dentist, veterinarian, and some registered nurses can also potentially qualify in the program. But ultimately, the benefit there is it can provide a lower down payment for higher loan options. But the biggest advantage is the kind of the way in which we qualify clients in terms of student loans is different than how Fannie Mae, Freddie Mac, and FHA will view student loans. So That's the big advantage there. There's a variety of different kind of paths we can go down with the physician's loan. So our person in class that asked that question, if you want to talk a little bit more offline, we can kind of see if that's a good fit for you. Because in some cases, based upon guidelines, conventional loans will give a little bit of a better fit than opposed to a physician's loan. Okay. All right, and then the next product is the VA product. That's for our veterans that have served, have VA home loan eligibility. It's a zero down payment option for the veteran, minimum credit score of 620. There really is no maximum loan amount for the VA product. And the low down payment or no down payment option obviously allows a lot more flexibility and really encourages participation for the veteran in home ownership. And a lot more flexibility in guidelines too, especially when we look at expenses versus income. We really want to encourage home ownership for our veterans. And then the USDA product allows a buyer to purchase in designated rural areas, zero down payment option as well, 620 minimum credit score. The loan amount size for that product will vary based upon essentially where I want to purchase in what county. Two major qualifiers on USDA is the location of the property. There's also household income limits. Now, most first-time buyers will comply with the FHA, VA, USDA, and conventional home loan products. And so we'll spend some time talking about first-time buyer products in just a few minutes. All right. Question in the chat was talk a little bit about PMI. So yes, we are definitely going to talk a little bit about PMI right now. And so PMI is something that comes up in our conversations with clients. I think it's important to understand what is PMI because I get that question a lot. Well, essentially PMI essentially insures the lender against a buyer default. So if the buyer had an event that caused them not to be able to make their payments, a private mortgage insurance would come in to help support the lender on a conventional loan. For an FHA loan, it's mortgage insurance premium, which is sponsored from FHA. It's a government insured product. They would do the same thing to support the lender in case of default. So let's take a look at the conventional loan product and how PMI is calculated. So it's based upon credit score. It's also based upon down payment. It's also based upon how much I decide to finance. So if some of our classmates have started looking on Redfin or Zillow, maybe you're using some of the calculator function, that's great. But what we found is some of the calculations don't necessarily add up on those calculators. So, when we actually do a full homebuyer consultation for you, we can give you kind of exact what the PMI calculation looks like. On a conventional product, PMI does have a cancellation option. So once I reach 2 years in the property and I have 22% equity, sometimes 20% equity, I can apply to have PMI canceled on a conventional home mortgage. Let's dive into what PMI looks like. So if we were to say I'm going to finance $250,000, I have a credit score of 740, and I'm putting a 3% down payment in, I'm probably looking at a premium of about $85 a month. Okay, so that's probably going to look a little bit different than what you've seen in some of your calculations initially on maybe Redfin or Zillow, right? So that's what the conventional loan product looks like. FHA wise, going to look a lot different because there's actually two forms of MIP or mortgage insurance premium. One is there's monthly mortgage insurance, which is 0.55% of my total loan amount. There's also upfront mortgage insurance, which is 1.75% of my total loan amount. That 1.75% gets added back into my total amount finance. So essentially with an FHA loan, I'm financing a little bit more money, right? Now with FHA, there is no cancellation option. So even if I reach 20% equity on my FHA loan, I cannot cancel it. I would have to basically refinance into a conventional loan to be able to remove myself from mortgage insurance. So if I was to take that same loan amount of $250, and then I have to add in the upfront mortgage insurance premium of $43.75, and then I have the monthly MIP of $116.58, now I can see kind of my comparison between the conventional and the FHA product. Now, I think it's important to kind of go back to our notes on the underwriting guidelines. FHA is going to be a lot more flexible than, say, the conventional product, especially if I have a higher expense ratio or maybe I have some challenged credit. FHA can be an awesome entry point for homeownership for our clients. So it's really, a matter of us kind of sitting down for a consultation and figuring out what is the right path for us as a future home buyer. And so that's kind of what the comparison looks like between both the conventional loan and the FHA product. I saw a comment in the chat about the recording of tonight's class. Yes, we are definitely recording class. I think Ken also jumped in there to let the group know. So everything that we're sharing tonight will be up on our YouTube channel for you tomorrow. All right. Before I start talking a little bit about qualifying income, any questions so far that we haven't addressed here for the group? I want to make sure that. Okay. Let's talk a little bit about qualifying income. And we're kind of looking here more as, what are the things do I need to, first of all, get together if I'm considering home ownership? So one is generally if I'm a W-2 employee, I would need to provide the most recent 2 years of W-2s, possibly the last 2 years of taxes for my income. And then and let me include too, the last 60 days of pay stubs. From an asset perspective, I may need to provide the last 2 months of bank statements. Okay. What I want to talk more specifically about around income is some of the guidelines, if you will, in home buying. So there is a 2-year requirement that we have to verify 2 years of employment and/or education. So here's what that means. If I graduated from Oklahoma State, let's say in the fall, I just started my new job January 1st of 2025. As long as I can demonstrate at least 2 years of education, or maybe employment, I now qualify for the 2-year rule. So oftentimes clients will come to us for a consultation and say, hey, I had this person tell me I have to have 2 years on my job. Not necessarily the case at all. As long as I can demonstrate 2 years of work and/or education history, then I could potentially qualify for a mortgage. All right. Even if I'm looking to transition from one employer to another. So in some cases, we'll have a client that's working on a current job right now, maybe has been there for the last 6 years, but wants to qualify with their new income that they're going to make from their job. They're starting March 1st. As long as that client can provide an offer letter, we can use that as being able to support the qualifying income for a pre-approval or ultimately their loan eligibility right away. Now, where 2 years and the ruling of 2 years gets a little bit more complicated comes into play, especially when I have dual employment. So let's say I'm in the healthcare industry and I work for maybe 2 separate locations, right? I have one location I work at 30 hours a week, another one at 40 hours a week. In that case, if I do want to consider both sources of income for my home purchase, I have to show that I've been on both jobs for at least 2 years. All right. Now, if I'm self-employed, a little bit different. So even if I'm a 1099 employee or I started my own business, in that case, I do have to show that I have 2 years of consistent tax filing. All right. Last thing I want to touch on income is other sources of income. So let's say I have a 40-hour work week job. Everything's great with that. But on the weekends, I also like to make a little extra money and I work and drive for Uber, right? Or Lyft, whatever the case may be. If I want to consider my Uber income, which is generally 1099 income, then I have to demonstrate that I've been doing both my 40-hour work week job and driving for Uber simultaneously for the last 2 years. And if I do have other sources of income, like let's say my partner has income that contributes to our household expenses, that's great. But for the most part, unless my partner is going to be part of the application, that income can't be considered for qualifying. All right. Okay, now as we kind of stick with this theme around income, I want to talk to you a little bit about expenses versus income. We call that debt to income ratio, and that's one of the metrics we use in evaluating lending options for clients. So we're simply looking at what's my total expenses look like today. So student loans, credit cards, personal loans, lines of credit, whatever I have, right? And I want to also add in my housing expense, which would include the principal and interest of my new mortgage, my property taxes of my home, my homeowners insurance that I'm paying. Maybe I'm paying private mortgage insurance, homeowners association expenses if I'm buying a condo, kind of a thing, right? So we kind of lump those all into expenses. And then I compare that versus what my pre-tax income looks like. And it creates a calculation called debt to income ratio. So we put a little bit of example on screen here. So we can see we have the PITI, principal interest, taxes and insurance. We have the PMI, HOA expense. So in this scenario, we have a client that's making $2,500 a month. Their other debts are $500 a month. So essentially they have $3,000 in outgoing debts and they're making $8,500 a month. So in that scenario, my client has a 35.3% debt to income ratio. So if we were to kind of evaluate guidelines for qualifying, I would say, we really don't want that number to be more than 45 to as high as 50% is kind of the top end. The comfort zone for most clients, we have it on screen, is kind of excellent. I would say is anywhere between 33 to 36%. That's where most clients feel pretty comfortable. That's kind of the sweet spot. But like I said, the highest you can go is probably 45 to 50%. Now, this is just a metric that we use for qualifying, doesn't necessarily indicate affordability. And that's one of the conversations that we're going to have as part of a comprehensive consultation with you, is figuring out, like, what's an affordable amount for me? It might be $1,500 a month in monthly expenses for my mortgage. It might be $2,500, right? But ultimately, we're going to figure out, how do we design a home buying plan that gets me to my goal of affordable home ownership? Okay, last stop in our discussion before we talk about first-time buyer programs and our workflow to owning a home is around saving for home ownership, as well as, if I've already started saving and I'm in a pretty good spot, like, what documentation is a lender going to need from me? So what is Jason going to ask for? Well, if I'm going to have my savings, or my funds for closing are in my checking and savings account, we need to see at least 60 days of asset statements for those accounts. Just keep in mind, like, things like cash deposits can't be used in qualifying for a mortgage. We're going to want to see that you've had stability in your deposit activity for the last 60 days. Retirement accounts, 401ks, 403bs can be potentially used. I always encourage clients, talk to your financial or tax advisor before we get access to those assets. Investment accounts can be potentially used. Again, talk to your financial advisor for the use of those funds. And sometimes we'll have family members that will want to contribute to the home purchase, right? And so those are called gift funds. There's a process to a donor helping out, but that's absolutely allowed in financing. One of the things that we like to encourage our classes with is looking at a savings plan for yourself, because so often I'm meeting with clients across the country and they're feeling pretty good about what their mortgage payment could potentially look like, but maybe they're new in their careers, maybe they just haven't got a chance to start that path towards savings for home ownership. So what we like to do is give you a really simple approach to a savings plan. And so if we were to think about home ownership versus renting, and let's say I'm currently renting at $1,500 a month in rent, right? But I feel like if I could buy a house at $3,000 a month, that's completely doable for me. So just looking at that simple math, right now I have a $1,500 difference between my rent versus what I think I can afford on a mortgage. So what I would encourage my client to do in implementing a savings plan is, on the first of the month when I transfer my rent funds to my landlord, get in the habit of doing the same thing with your savings account. Take that additional $1,500 that you think you can afford on a mortgage, transfer that to your savings account. So now we develop the habit of saving $1,500 per month on an ongoing basis. Before the end of 6 months, we're at like $9,000 in savings. End of the year, we're at $18,000. That creates a huge nest egg for us in homeownership. Not only does it do that, but it also creates the discipline and really the rhythm of making a $3,000 expense to your household budget. And so when I move towards homeownership and I do find a home and I'm in my home, it doesn't feel like such a big payment shock for me when I start making my payments on my mortgage. Okay, so that's a really simple savings plan approach. We'd encourage you to think about that as you kind of prepare for home ownership. Okay, I want to answer a couple quick questions in the chat. One question was, my tribe offers a down payment assistance program. Would that be considered a gift fund? I'd have to look at the stipulations of the offering, but that would probably be gift funds, and that's completely allowed. There's no seasoning requirement on gift funds, so that could potentially work. Let's maybe talk offline a little bit more about that, make sure I understand all the details of that. But yeah, that could definitely work. All right, let's talk really quickly about assistance programs specific to Oklahoma and really all parts of the country. Most states have an affordable housing agency designed to support low to moderate income households in your specific state, because I know we're not all in Oklahoma in tonight's class. But in Oklahoma, there is a housing finance agency that can provide up to 3.5% of your sales price in assistance funds. Those can be used towards down payment or closing costs. Usually lower rate options are available with those products. And there's also special incentives that are available for teachers, first responders, and some of the state of Oklahoma employees. Now, if we're in Massachusetts or we're in Tennessee, like I think some of our classmates are, There's other or similar programs. For timing purposes for tonight's class, we can talk offline about that. And someone just put in the chat that Massachusetts does have this. And so, yeah, so there's available options in different parts of the country. So let's talk more offline about what could be more suitable for you. Nationally, as APM, we do have we call it a pathway down payment assistance program. Works specifically with the FHA product. It does provide 3.5% or up to 5% of the loan amount in assistance funds. Fannie Mae and Freddie Mac also have low-income housing sources. So if you're considered low-income housing, which is generally less than 80% of the median income for your respective area that you want to buy in, there can be some other products available. We also partner with other banking institutions nationally that have community redevelopment programs that can also provide some additional options for you. So I think that the takeaway from our first-time buyer section is there's a lot of great resources available to you as first-time buyers. And I think it hopefully dispels the myth that, I have to put 20% down to buy a home. It's not necessarily the case. Not only is there low down payment options, but there's a lot of great assistance resources for you as well. One question in the chat was, if I took $10,000 from a Roth IRA, would that help me on my qualifications? Absolutely can be used. We can allow that in the financing. I would just encourage you to talk to your tax or financial advisor, make sure we don't create a tax event for ourselves. Okay. All right. Good questions there. I know about 10 minutes from the top of the hour because we'll be wrapped up at top of the hour, your local time. But before we do wrap up, I do want to walk you through the buying process, which I think is a really important part of understanding where do I go from here. Because after tonight's class, you'll get all the recorded follow-up material, as well as the links to get started in our process. We love to be able to get connected with you for a consultation. I meet with every client all across the country through our different university partnerships, through the Alumni Association on a daily basis. If I'm not teaching classes like this, I want to help be a partner for you in that path towards homeownership. We're licensed all across the country to help support you in whatever market you're in. And so a consultation essentially is a 30-minute session with me to help really design a home buying option for you. And the output of that session with us is to essentially have a pre-approval design for you. A pre-approval is essentially a document that you can present to a seller that tells them that you're fully qualified for your mortgage. A pre-approval is usually good for 60 days, but it can always be recertified at any time. So I may not be considering purchasing until the end of the year, but we would encourage you to still get your pre-approval because it only is a soft inquiry and it creates a little bit of a baseline for you with homeownership. So you know exactly what your goals and objectives look like with homeownership. Okay, so that's step one in the buying process. Step two is going to be the fun part. That's the house hunting phase. And some of you in tonight's class have maybe already started house hunting, right? Maybe you're doing that on Zillow or Redfin today. It usually will go from online to in-person. And we would encourage you for that in-person to get connected with a local realtor in your community that you feel comfortable representing you. A realtor should be experts in negotiating with a seller, should be experts in their market, understand what median prices look like and buyer activity and seller activity looks like. And they should be able to have partners that they can use to help really kind of do investigative work for you on this particular house. Now, we have preferred realtors in our network that it's growing day by day across the country that we can connect you with. But step two is that kind of process of going from, looking online to let's go and kind of do some work on a home and see if it's something we really like, right? Now, let's say we find the home that we like, we make an offer on the house, the offer gets accepted. Well, that will move us to step three. And step three is called entering escrow. It's categorized as different things across the country, but in general, it means that I have an agreement with the seller to purchase their home. Now, that same day that I get that accepted offer, you're going to get a call from me saying, congratulations. That is a huge accomplishment. And just kind of give you more of a, what's going to look like as we move forward in the process. We're going to schedule you for a follow-up video session, which is a 30-minute session we do to make sure your financing is designed properly. We're going to talk a little bit about the state of interest rates. What's our monthly payment look like on this particular property? Just make sure all the financing is dialed in for you. Now, usually within 3 days of your accepted offer, you have to make a contribution. We call that an earnest money deposit for your home purchase. Essentially is an investment in going into escrow that tells the seller that you have a financial stake in the success of this transaction, right? Now, Within 2 to 3 days of that accepted offer, we meet with you for your follow-up video session. We also send disclosures to you that outline all the financing that we've reviewed in your follow-up consultation. And you'll get different iterations of disclosures as we move through the process, so they're all e-signature documents. This slide kind of highlights for you what an earnest money deposit is. It's categorized as different things across the country, but ultimately it's your financial investment in this purchase. Usually to the tune of 1 to 2% of the purchase price. Now, in most parts of the country, there's what we call as contingencies tied to your purchase contract, which essentially allows you as a buyer to do homework on the property. Things like, let's get the house appraised. Let's make sure the house is worth what you're buying it for. Let's get inspections done to make sure the house has no issues with it. And certainly let's get your loan approved, right? Usually that has to happen in the first 2 to 3 weeks of the agreed upon contract timelines for your home purchase. Now, as we move through the buying process, there's different milestones like the processing and the underwriting of the loan. Those are more of the administrative functions of the loan. We want to do things like verify your income or employment, verify the assets being used. We're going to kind of get the disclosure packages delivered to you. And then our underwriter will complete a review of the entire loan. Now, that will take us to step 5 at loan approval and almost gets us to about 3 weeks into the buying process. So the underwriter has now issued an approval. We have now kind of dialed in all the numbers for our financing at that point. Also takes us to the end probably of the contingency period, the investigative period for you as a buyer. So if we feel good about the reports we've gotten on the house, the appraisal checks out supporting the purchase price of the home, we have our loan approval, then we can release our contingency on this particular property. It basically tells the seller that we're ready to move to the final stages of the process. We also, as a lender, once that contingency is removed, deliver to you a final closing disclosure, which essentially gives you a 3-day cooling off period before we get to the very final milestone, which is called closing the loan. And that's where you sign final loan documents in public with a public notary, I should say, or an attorney, depending on what state you're in. That same day, you'll usually wire in the final funds for your home closing, as well as the loan funds that we deliver for you as you're financing. It gets sent into the escrow or attorney's office as well. Okay, those monies get reconciled and then documents get recorded with a county recorder's office. They usually record what we call as a grant deed to transfer ownership to you, as well as the deed for the loan. And after that's all confirmed is recorded, then I get to make my favorite call of the day. Got a chance to make a few of those this morning, which is to say congratulations. Guess what? Now you're the new homeowner. And it's a huge day of celebration because it's a big deal, right? As I kicked off tonight's class, probably one of the biggest financial decisions you're going to make. And so, to be able to celebrate that with our buyers is a huge deal for us. To go from a class like this in a learning environment, get pre-approved, find your dream home, and then get the keys is a huge accomplishment. Well, our relationship doesn't stop after that. We have an aftercare program we do after you get to the keys to your house. That includes watching the market through our Rate Watch program to make sure that when the time does come for you to refinance, that you have all the availability of resources to you. We have a HomeBot system that tracks the progress of your home value. And we do annual check-ins with our clients just to see what's happening, right? Things change for our clients throughout the years. Financially, family grows. Maybe the home that we needs to grow. The place I'm going to buy to, maybe I get relocated with my employer. We want to kind of be there for you as all those life changes happen. Well, as we wrap up tonight's class, I want to let you know, how do you get started in the process if you want to? It's a free service we provide as a consultation that you've heard me kind of talk about a little bit in tonight's class. It's a very simple 3-step process to begin this process, which includes just completing a really easy online application. We only do a soft credit check, so you don't have to worry about your score being impacted. Then you upload required documents in your application and use our scheduling system that you can see here to book an appointment. That appointment will be a one-on-one with me to sit down on video over 30 minutes and let's just map out a plan, right? You don't have to go run out and buy a house this weekend. I would encourage you not to do that, but it's just to get a roadmap in place for yourself. So whether I want to make this a 2025 goal for myself or it's a goal for 2026, we just want to be a partner for you to help educate you on that path towards homeownership. Now, if you have some questions after tonight's class, I know we had some specific gift questions. We had some questions around first-time buyer programs in a particular state. Get connected with us for an introductory call. You can also use the same scheduling system to book that call. Here's what a consultation looks like. Again, this is a free service that we're providing to our local communities. In that consultation, we're going to understand, where do I want to purchase? What's my budget need to look like? Do I have some areas of opportunity on my credit to improve my credit so I have cheaper financing? Are some assistance programs going to benefit me in my local market? What's the buying process need to look like for me? All of those things will happen in that consultation. This is significantly different than what most lenders will do. So most lenders will just take an application and tell you what you qualify for you. We really value education, so the consultation is a major part of that. I want to point out one of our resources for you that's available both on Android and on Apple devices. This is our mobile app. In fact, you can start the application all from mobile. You can also chart your course in homeownership right on mobile, and really use the calculation functions, which is super helpful in mobile as well. So if I'm out at an open house on Saturday and I kind of want to know what my payment looks like, you can do that all via mobile. I want to also point out again, I kind of touched on it earlier, our benefit in our Oklahoma State Alumni Partnership, which is we discount our services for you by $750, which is a significant amount for you in your home financing plan. Of course, you have access to your home buying classes. We're going to do 3 more classes this year, and we're in a multi-year agreement with the Alumni Association. So if you have friends, family, coworkers that think would benefit from these classes, please have them check out some of our available classes upcoming for this year. And we have other partnerships across the country. Oklahoma State is one of our newer partnerships, and we're really excited about what we're going to be able to bring to the community. But you can see on screen, we have some other partnerships across the country as well. And this is all my contact information. So if you want to get connected with me, just want to shoot me an email or hop on our website or send us a text message, you can get a hold of me through those methods. We have our social channels as well that we'd encourage you to check out. We try to put out some good content on socials that benefit you as first-time buyers. And of course, tonight's class will be up on our YouTube channel tomorrow. Last thing I want to point out is, it's important to understand who you're partnering with on this journey. And so we love what our communities say about us. So, feel free to check out what, our local communities say about us on our social channels, on Reddit, on, Google channels, because we really take pride in helping you with your #1 financial decision. Well, with that said, I'm at the end of tonight's class. I did it. I actually arrived on time, but I do want to take any questions that we have from the audience. Ken's helping me out in the chat with some of those questions, but most of you guys have hung on in class, and I really appreciate that because I'm probably just in front of dinner time for you in most of your time zones. So what questions do we have from our audience that I can help? And you can answer or ask those in the Q&A or chat. One question, in case you guys didn't see in the chat, is do you need to be just alumni or actually in the official alumni association? So our discount program is open to everyone affiliated with Oklahoma State. So, yeah. All right. And we just really put that in place because we want to create low, affordable options for you. We understand the cost of housing is super expensive these days, and so we hope that benefit kind of makes it a little bit more attainable for our local communities. And thank you for the feedback in the chat. I appreciate that. It's very nice of you. We've had a lot of great feedback here, and we love doing these classes. And like I said, I'd encourage you to share this content with friends, family, and coworkers. We really believe in the power of education and homeownership, and so that's why we're really passionate about delivering this locally. All right. Let me answer this question. I think this might kind of wrap us here. And so the question is, if I'm not quite ready to do the pre-approval process, would it still be a good idea to do a consultation to get questions answered specific to my scenario and region? Absolutely, yes. So, the pre-approval basically kind of closes the loop on everything we do in the consultation, but we can still do a consultation, not be pre-approved. There's no kind of it doesn't change anything. But I always encourage everybody to do consultations just to get a good roadmap and set some goals and objectives for homeownership. So yeah, absolutely. Okay. All right, you're welcome. All right, everyone. Well, thank you so much. I really enjoyed our first class here for Oklahoma State. You guys have been an awesome class, and I really do hope I get a chance to get connected with each of you. Have a wonderful evening, and I look forward to seeing you soon. Good night.